We've been sold a lie. The story you know, the one about a sudden, inexplicable market crash plunging the world into darkness, it's incomplete. Dangerous even. Because it hides the real culprit. It wasn't just bad luck. It wasn't just greedy speculators having a bad day. The Great Depression wasn't an accident. It was the inevitable catastrophic failure of a financial system deliberately rigged to concentrate wealth at the very top. And then, when it imploded, erased the life savings, the homes, the farms, and the generational futures of millions below. How did Wall Street, the engine of American prosperity, become the architect of its most devastating collapse? And why does the blueprint for that disaster feel so familiar today? Welcome. Today, we're diving deep into the darkest economic chapter of the 20th century. But this isn't just history. This is a forensic investigation into how financial systems can be weaponized, how prosperity built on sand inevitably collapses, and how the wealth painstakingly accumulated over generations by ordinary families can vanish in a puff of smoke, orchestrated not by fate, but by the very institutions meant to safeguard it. We'll uncover the hidden mechanisms, the key players who saw it coming, and those who ignored the warnings, and the brutal reality of what erased generational wealth truly meant. And by the end, you'll see chilling echoes in our own time. Stick with me. The answers are more relevant than ever. To understand the fall, we must first understand the dizzying, deceptive height of the rise. The 1920s weren't just roaring, they were roaring on credit. America emerged from World War I as the undisputed global economic powerhouse. Industrial output soared. New technologies, radios, refrigerators, automobiles, promised a utopia of convenience. And Wall Street? Wall Street became the temple where this new prosperity was worshipped and where its foundations were fatally weakened. But here's the twist most histories gloss over. This boom wasn't shared. While the Dow Jones Industrial Average skyrocketed nearly 500% between 1921 and 1929, the reality for most Americans was starkly different. Wages for industrial workers barely kept pace with inflation. Farmers, crushed by falling crop prices after the war boom, were already in a depression years before the stock market crashed. Meanwhile, the top 1% saw their share of national income balloon to nearly 24%, a level not seen again until... Well, we'll get to that. The prosperity was a mirage, concentrated at the very peak, built on a foundation of sand, debt, and speculation. Enter the engine of the bubble, buying on margin. Imagine wanting to buy $1,000 worth of stock. Instead of paying the full amount, your broker lets you put down just $100, 10%, and lends you the other $900. This is leverage. It amplifies gains, but it also catastrophically amplifies losses. And in the late 1920s, margin requirements were absurdly low, sometimes as little as 10%. Brokers were practically giving money away to fuel the frenzy. But it got even more dangerous. Enter the investment trust. Think of it as the 1920s version of a complex hedge fund or a leveraged ETF. These trusts didn't just buy stocks. They bought other investment trusts, which in turn bought more trusts, creating towering, unstable pyramids of debt and ownership. The most infamous? The Goldman Sachs Trading Corporation, launched in 1928. It started with $100 million in capital. Within a year, through layers of leverage and cross-ownership with other trusts it controlled, it was manipulating a portfolio valued at over $1 billion. That it was financial alchemy, turning thin air into apparent wealth. And the man behind much of this? Charles E. Mitchell, the charismatic, aggressive head of National City Bank, a precursor to Citibank. He famously declared in early 1929, "There has been no evidence of overspeculation. The market is sound." He was wrong. Dangerously wrong. While Mitchell and his ilk peddled optimism, others saw the abyss. Roger Babson, a respected economist and businessman, stood up at a financial conference in September 1929 and declared, "Sooner or later, a crash is coming, and it may be terrific." The market dipped slightly, then roared back. He was mocked. Paul Warburg, a founding father of the Federal Reserve, warned of a perfect orgy of speculation and undue expansion of credit. He was ignored. Even Herbert Hoover, then Secretary of Commerce and soon-to-be President, expressed private concerns about crazy and dangerous speculation. But publicly, the administration echoed the Wall Street chorus, "Permanent prosperity is here." The stage was set. The bubble was inflated beyond reason. The warning signs were flashing red. but the machine of speculation had its own momentum. Then, the spark. It started subtly. In early September 1929, the market peaked. Then, a series of unsettling dips. On October 24, 1929, Black Thursday, panic truly began. The ticker tape, overwhelmed by the volume of trades, fell hours behind. Investors on the floor couldn't see real-time prices. Rumors flew. Fear became contagious. A record 12.9 million shares traded, a staggering number for the time. Brokers, facing margin calls they couldn't meet, were ruined. But the real horror was yet to come. Over the weekend, bankers, led by Charles Mitchell and Thomas Lamont of J.P. Morgan, desperately tried to project calm. They pooled millions to buy key stocks, hoping to stem the tide. For a moment on Friday, it seemed to work. Then came Monday, October 28th, Black Monday. The Dow plunged nearly 13%. Confidence evaporated. And then, Tuesday, October 29th, Black Tuesday, the dam broke. 16.4 million shares traded in a single day of utter chaos. Prices collapsed. Margin calls went out like death warrants. Brokers liquidated positions indiscriminately, driving prices down further in a vicious cycle. The ticker tape lagged so far behind that by the time investors saw a price, it was already obsolete and far worse. Billions of dollars in paper wealth vanished in hours. But here's the critical point often missed. The stock market crash didn't cause the Great Depression. It was the detonator. The real catastrophe unfolded in the years that followed, as the initial shockwave ripped through the entire economic fabric, erasing not just paper gains, but real, tangible, generational wealth. The crash shattered confidence. Banks, heavily invested in the stock market themselves or holding loans backed by now worthless stocks, began to fail. Between 1930 and 1933, over 9,000 banks collapsed. When a bank failed, everything inside, savings accounts, checking accounts, the life savings of farmers, shopkeepers, factory workers, simply disappeared. There was no FDIC insurance, your life's work. Your children's inheritance, your parents' retirement, gone. Poof. Erased by a system that prioritized speculative gains over depositor safety. Consider the farmer, already struggling in the 1920s. They'd often borrowed against future crops to buy new machinery, hoping for better yields. When crop prices collapsed further after 1929, they couldn't repay. Banks foreclosed. By 1933, nearly half of all American farms faced foreclosure. Generations of tilling the same soil, building barns, raising families, wiped out. The land, the legacy, gone. And it wasn't just farms. Homeowners who had bought during the boom with small down payments saw their property values plummet below their mortgage debt. They walked away, losing everything they'd put in. Homeownership rates plummeted. The dream of building equity, of leaving a home to your children, turned to dust. Businesses, starved of credit and facing vanishing consumer demand, shut down. Factories fell silent. Wages evaporated. Unemployment soared to 25%. For those who kept jobs, wages often fell by 40% or more. Families that had scrimped and saved for decades to buy a modest home, send a child to college, or start a small business saw those dreams obliterated. The wealth wasn't just lost. The opportunity to rebuild it was crushed under the weight of systemic failure. This wasn't a temporary setback. It was a multi-generational wipeout. Studies show it took until the late 1950s for average family wealth to recover to 1929 levels. Think about that. 30 years of lost progress, lost security, lost potential. President Herbert Hoover, often unfairly caricatured as doing nothing, actually did a lot. But his actions were tragically misguided by the economic orthodoxy of the time, liquidationism. The belief was that the economy needed to purge its excesses, that wages and prices needed to fall to clear the market. So, his administration raised taxes in 1932, the Revenue Act, to balance the budget, sucking even more money out of the struggling economy. Signed the Smoot-Hawley Tariff in 1930, the highest in U.S. history, triggering global trade wars that strangled international commerce. Opposed direct federal relief to the unemployed, believing it was the job of states, localities, and private charity, institutions utterly overwhelmed by the scale of the crisis. The result? The crisis deepened. The banking system remained fragile. Confidence stayed shattered. Hoover's policies, rooted in a belief that the market would self-correct if left alone, a belief heavily influenced by Wall Street advisors who feared government intervention, proved catastrophic. They turned a severe recession into the Great Depression. The message to ordinary Americans was clear. The system, and those who ran it, cared more about abstract economic theories and protecting the remnants of financial power than about their shattered lives and erased futures. It took the election of Franklin D. Roosevelt in 1932 and the radical intervention of the New Deal to finally begin the long, painful climb back. The creation of the Securities and Exchange Commission, SEC, to regulate Wall Street, the Federal Deposit Insurance Corporation, FDIC, to guarantee bank deposits, the Glass-Steagall Act separating commercial and investment banking. These were direct responses to the specific failures that erased generational wealth. They were designed to rebuild trust and prevent a repeat. And for decades, they largely worked, which brings us to the uncomfortable question, have we learned the lessons or are we sleepwalking towards a similar, if differently shaped catastrophe? Let's look at the data. It's unsettling. Then, top 1% held fewer 24% of national income, 1928. Now, top 1% holds less than 20% of national income, 2023. Top 10% holds nearly 70% of wealth. The concentration is back to Gilded Age levels. Then, explosion of consumer and margin debt fueled the 1920s bubble. Now, total U.S. household debt just hit $17.7 trillion Q1 or 2024. Credit card debt alone is over $1.1 trillion, a record high. Student loan debt, $1.7 trillion. Auto loan debt, $1.6 trillion. We are drowning in debt, much of it high interest. Then, market valuations reached extreme highs before the crash. Now, the Shiller-Cape ratio, a measure of long-term valuation, is currently in the top 5% of its historical range, levels only seen before the 1929 crash, the 2000 dot-com bust, and the 2008 financial crisis. The market is priced for near-perfect perpetual growth. And the mechanisms? They've evolved, but the core dynamics feel eerily familiar. Leverage is back, not just in stocks, via options, futures, margin, but in the entire financial system. Hedge funds, private equity firms, and even major banks operate with staggering levels of debt, amplifying risk. Complexity breeds fragility. Remember the 1920s investment trusts? Today, we have collateralized loan obligations, CLOs, mortgage-backed securities, MBS, and intricate derivatives markets. These are often poorly understood, even by regulators, creating hidden linkages and systemic risk, just like the cross-owned trusts of 1929. The 2008 crisis was a direct result of this, the everything bubble. Ultra-low interest rates for over a decade have inflated all asset classes, stocks, bonds, real estate, even art and crypto. This creates a false sense of universal prosperity, masking underlying fragility and making the eventual correction potentially more severe across the board. Erosion of safeguards. Key New Deal protections like Glass-Steagall were systematically dismantled starting in the 1980s and culminating in the Gramm-Leach-Bliley Act of 1999. This allowed the very same institutions that take your deposits, commercial banks, to engage in high-risk Wall Street speculation, investment banking again. The firewall is gone. We saw a preview in 2008, the subprime mortgage crisis fueled by reckless lending, complex securities, and excessive leverage triggered a global financial meltdown. Millions lost their homes, their primary source of generational wealth. Retirement accounts were decimated, unemployment soared. It took a massive, unprecedented government bailout, primarily of the financial institutions that caused the crisis, to prevent a full repeat of the 1930s. But the underlying structures, the incentives for excessive risk-taking, the concentration of wealth, they remain largely intact if not amplified. The warning signs are flashing again. Extreme inequality, record debt, frothy asset markets, complex financial instruments, and a regulatory environment that often seems more focused on enabling Wall Street innovation than protecting Main Street stability. The ghost of 1929 isn't just history, it's a cautionary blueprint. So what do we take from this harrowing journey into the abyss? 3 critical lessons. Wealth. Concentration is systemic risk. When prosperity is hoarded at the top, the entire economy becomes unstable. The spending power of the many drives sustainable growth. When that base erodes, the whole structure becomes vulnerable to collapse. Extreme inequality isn't just unfair, it's economically dangerous. Debt-fueled bubbles always burst, whether it's margin loans in 1929, subprime mortgages in 2008, or today's record consumer and corporate debt. Borrowing to chase ever higher asset prices creates an illusion of wealth that vanishes the moment confidence falters. Leverage magnifies gains, but it guarantees catastrophic losses when the tide turns. Regulation isn't red tape, it's a safety net. The New Deal reforms weren't anti-business, they were pro-stability. They recognized that unfettered financial markets, driven by short-term greed and complex opaque instruments, will inevitably prioritize profit over prudence, erasing the wealth of ordinary citizens in the process. Strong, smart regulation protects the system and the people within it. Here's the warning. The mechanisms that erased generational wealth in the 1930s haven't disappeared. They've adapted. They wear new clothes. Algorithms instead of ticker tape, CLOs instead of investment trusts, fintech apps instead of margin clerks. But the core dynamic remains, a financial system that can generate immense paper wealth for the few while leaving the many perilously exposed to its inevitable failures. The next crisis might not look exactly like 1929 or 2008, but the potential for widespread generational wealth destruction is very real. So, what can you do? This isn't just about waiting for politicians or regulators. Knowledge is your first line of defense. Understand your own finances. Avoid excessive high-interest debt. Diversify your investments. Don't chase bubbles. Demand accountability. Support policies and representatives who prioritize financial stability, consumer protection, and fair taxation over Wall Street deregulation. Stay informed. Understand the financial news beyond the headlines. Question narratives of permanent prosperity. The Great Depression wasn't just a historical event. It's a stark, enduring lesson in the fragility of wealth built on sand and the devastating human cost when the financial system prioritizes speculation over security. The ghosts of those who lost everything, the farmers, the shopkeepers, the factory workers, remind us that prosperity must be broad-based and resilient to last. Will we heed their warning? Or are we destined to watch history repeat its most painful chapters? If this deep dive into one of history's most crucial economic lessons resonated with you, smash that like button. It tells YouTube this matters. Subscribe and hit the notification bell so you don't miss our next investigation into the forces shaping our financial future. Most importantly, share this video. Talk about it with friends, family, colleagues. The more people understand how wealth can be erased, the better equipped we all are to protect it. Drop your thoughts, questions, or parallels you see in the comments below. Let's keep this vital conversation going. Thanks for watching and stay curious.